Imagine this for a moment. Back in 1998, the world was going crazy for the internet. New companies were popping up everywhere with names ending in .com, and investors were convinced they had found the next big thing. People were pouring their money into tech stocks, and for a couple of years, it felt like easy money. Everyone who invested early looked like a genius. Then came the year 2000. The Nasdaq crashed nearly 80%. Many of those .com companies disappeared almost overnight. Only about 48% of them survived. People who had invested heavily lost millions within days. Even some of the biggest names in tech took massive hits. It was one of the worst crashes in stock market history. The crazy part? The internet really was the next big thing. The technology was real and transformative. But the hype, overvaluation, and blind optimism created one of the largest bubbles in financial history. Now, fast forward to today, and I can't help but feel a very similar energy in the market again. But this time, it's not the internet driving the excitement. It's artificial intelligence. People are calling AI a once-in-a-lifetime opportunity, and maybe they're right. Or maybe we're watching the same story play out again with different characters. History doesn't always repeat, but it often rhymes. As someone who has helped over 7 million people start their investing journey, I feel a responsibility to give you my honest opinion on what's happening right now. So before you make any big decisions with your money, let's break this down properly. Chapter 1: The Magnificent Seven and the AI Arms Race. Right now, the direction of the entire U.S. stock market is heavily influenced by just 7 companies. They're commonly known as the Magnificent Seven: Amazon, Microsoft, Alphabet, Google, Meta, Apple, Tesla, and Nvidia. Together, these 7 companies make up around 36% of the entire S&P 500 index. That means even if you own a simple S&P 500 index fund, a big part of your investment is riding on how well these companies perform in the AI race. These companies are currently in an intense competition to dominate artificial intelligence, and the amount of money they're spending is staggering. Here's what they're expected to invest in AI this year alone. Tesla is planning to spend around $5 billion on autonomous driving and XAI. Apple is spending over $10 billion to improve Siri and other AI features. Meta is investing around $60 billion into data centers and AI infrastructure. Google is spending about $75 billion to rebuild its systems around AI. Microsoft is putting in roughly $80 billion, much of it going toward OpenAI and supercomputers. Amazon is investing around $100 billion into AWS to strengthen its position as the backbone of AI infrastructure. That adds up to roughly $330 billion in a single year. To put that in perspective, this is more than the entire GDP of countries like Finland or Portugal. This kind of spending is keeping the U.S. economy afloat right now. Without this massive investment in AI, many economists believe the economy could already be in a mild recession. The big question is, how long can this level of spending continue? Chapter 2: The AI Money Machine and Circular Investments. Now, here's the part that concerns me the most. There's a complex web of investments and transactions happening between these big AI companies that looks a lot like money moving in circles. Let me explain it simply. Microsoft invested billions into OpenAI. OpenAI then uses a large part of that money to pay Microsoft for using its data centers and cloud services. Microsoft then uses that revenue to buy massive amounts of chips from Nvidia. Nvidia, in turn, has also invested back into OpenAI and other AI startups. This cycle allows each company to record revenue and growth, which pushes their stock prices higher. It's not completely fake money moving around, but the level of interconnection is unusual and creates a situation where each company's success is heavily tied to the others. Recently, this has become even more extreme. OpenAI announced a massive $300 billion deal with Oracle. Oracle then said it would spend tens of billions buying Nvidia chips. Nvidia, in response, offered to invest up to $100 billion back into OpenAI, but only if OpenAI continues buying more of its chips. Nvidia is currently the biggest winner in this entire setup. Its stock price has increased by over 1,600% since ChatGPT was launched. The company sells its chips to almost everyone: Microsoft, Meta, Google, Amazon, OpenAI, and Oracle, and is also investing in many of these same companies. While this creates short-term growth in stock prices, it raises an important question: how much of this demand is real, and how much is being supported by this circular flow of capital? Chapter 3: The Real Problem. Are AI companies making money? This brings us to the biggest issue I see with the current AI boom. Most of these AI companies are still not making meaningful profits. OpenAI, for example, is valued at around $500 billion, but its actual revenue is only around $12 billion. The company is still losing money every month. The big hope is that in the future, these companies will be able to monetize AI at a much larger scale, through advertising, enterprise subscriptions, or by replacing human workers in many industries. However, there's another major challenge approaching: the data wall. For the past few years, AI models have been trained on massive amounts of publicly available data from the internet. By 2027, experts believe AI will have consumed nearly all of the high-quality human-generated data that exists online. After that, progress may slow down significantly because there won't be enough new data to train more advanced models. This is a real limitation. If AI progress slows down while expectations remain extremely high, it could lead to disappointment in the market and put pressure on stock prices. Chapter 4: Is this really like the dot-com bubble? Many people are comparing today's situation to the dot-com bubble of 1999 to 2000. So let's be honest about the similarities and differences. The similarities are clear: extremely high valuations, massive amounts of capital being invested with uncertain returns, a lot of hype, and "this time is different" thinking. Concentration of gains in a small number of stocks. But there are important differences too. Unlike many dot-com companies that had no real product or revenue, today's leading AI companies have actual technology that is already being used. AI tools are genuinely improving productivity in many industries. This makes the current situation stronger than the dot-com era in some ways. However, the valuations are still very high, and much of the current stock prices depend on the belief that AI will deliver massive profits in the coming years. If those profits take longer to arrive than expected, the market could face a painful correction. Chapter 5: What should you do as an investor? I'm not a financial advisor, but here's how I would think about this situation if I were in your position. 1. Keep investing, but do it consistently and smartly. If you're investing in a low-cost, broad index fund like the S&P 500, continuing to invest regularly can be one of the best strategies during uncertain times. When the market drops, your fixed monthly investment buys more shares at lower prices. 2. Don't panic during downturns. Market crashes are painful, but they're also a normal part of investing. The people who usually come out ahead are those who stay invested and continue buying during the downturn rather than selling in fear. 3. Focus on diversification. Don't put all your money into AI-related stocks or tech. A well-diversified portfolio that includes stocks, bonds, and other assets tends to handle market volatility better. 4. Increase your income. Your ability to invest more money is one of the biggest factors in building wealth. If you can increase your income through a better job or side income, it gives you more power to take advantage of opportunities when the market is down. 5. Avoid taking on too much debt. This is very important. Many people who got hurt badly in past market crashes were over-leveraged. Make sure your personal finances are stable before taking big risks in the market. Chapter 6: Final Thoughts. AI is a powerful and transformative technology. It has the potential to change how we work, create, and live. However, when massive amounts of money, high expectations, and rapid technological change come together, bubbles can form. The important thing is not to try and perfectly predict whether or when the bubble will burst. Instead, focus on building a strong, disciplined investment approach that can survive both good times and bad times. If you invest consistently in quality assets, stay diversified, and avoid making emotional decisions during market swings, you'll be in a much better position regardless of how the AI story unfolds. Thank you so much for watching. If this video helped you understand the current situation better, please give it a like and consider subscribing to the channel for more content like this. Drop your thoughts in the comments. Do you think we're in an AI bubble, or is this time actually different? I read every comment. I'll see you in the next one. Take care.